right, good morning, everyone. Thanks for joining us this afternoon for our complimentary webinar. This is part of our webinar series associated with the Unmanned Aerial Systems Cluster Initiative of Oklahoma and Kansas. Today's topic is Exit, Stage Right, Effective Strategies for Investors and Entrepreneurs. Before we get started, I'll tell you a little bit about the Cluster Initiative. We are an effort that is supported by a contract through the Small Business Administration. And all of our programs are designed to support and leverage the assets related to unmanned aerial systems in the states of Oklahoma, Kansas, and nationally. So through this program, we were able to provide workshops, training, capital formation efforts, leverage and work with our startup companies in the region, and also work with new technologies developing out of universities and federal labs that are going to have potential UAS applications. So as I mentioned, this is part of our webinar series, one of the programs that we provide through this effort. So today we've got two speakers who are going to talk about exit strategies from two different perspectives. We have a serial entrepreneur and then also an investor. So we're going to kind of take that approach and learn a little bit more about their experiences, offer some guidance on potential exit strategies and why they're important to think about early as you're developing your company. So our very first speaker is Tracy Poole. And Tracy is an investor and entrepreneur. He's an experienced transactional lawyer and is of counsel to the McAfee and Taft law firm, the largest firm in Oklahoma. Tracy's practice is focused on venture capital, private equity, energy, financing, M&A, and related transactions as he navigated many divestitures. Tracy is also a serial entrepreneur and has started and exited many private investments. In addition, Tracy currently participates in many seed and venture stage investments through its family office vehicle, Waterfront Capital LLC. He participates on the boards of Commerce Bank and MITO Material Solutions. He's also a member of the Oklahoma State University Foundation Board of Governors, and is also an advisory board member of the Oklahoma State University School of Entrepreneurship. Tracy, you're a graduate of the Oklahoma State University and the University of Oklahoma College of Law, and he's calling in from Tulsa, Oklahoma this afternoon. Our next speaker is Maximus Yanni, and he's a serial entrepreneur, engineer, and avid inventor. Maximus has a deep passion for building things and loves to experiment, fail fast, learn, and repeat. Maximus believes in first principles thinking. Whenever possible, he bypasses preconceived notions and starts from scratch. When he founded Titan Aerospace to build low-cost, high-altitude, solar-powered drones that could provide internet to the 3 billion people without it, he started with a blank slate, initially working out of his apartment. A few years later, Maximus sold Titan to Google. So both incredibly impressive backgrounds from our speakers today. And I know you guys are going to share a lot with us. So Tracy, I'll turn it over to you first. I've read your bio, but tell us a little bit more about yourself. What does your bio not include? Which I'm sure there's a lot there.
Well, the main thing is the bio included schooling both at Oklahoma and Oklahoma State University, but I'm an Oklahoma State fan, so I think everybody needs to know that first and foremost. Other than that, I think you did a pretty good job capturing the bio. I mean, I'm just a guy that stays busy on deals mostly, whether I'm working on a deal for clients or I'm participating in one myself. You know, I've been through the gamut of these things, both as an investor, as a team member, or founder of an operating company and or board member. So I've kind of seen and done it all. I tend to invest mostly personally at the seed or angel stage, a little bit of venture, but usually on the smaller end. My clients that I represent with these activities range from everything to a very, very small company all the way to, you know, Fortune 500 public company. So it really runs the gamut.
Excellent. Thank you. And Maximus, tell us a little bit more about yourself. I love your bio. Obviously, you've just had a massive sale to Google, which is what most people imagine as the ultimate exit strategy. So tell us a little bit more.
You know, I'm just your quintessential entrepreneur. Started with the lemonade stand as a kid and just never stopped. Kept going. tried to go to school, studied microelectronics, comp sci for a little while, and ended up just dropping out because I was always building businesses on the side. But I went down that path, and my father was the one that really turned me on to aviation as a child. I grew up in and around old cheap airplanes, flying all over the place, and as I went through sort of my midlife crisis, I really started to look for what was that thing that I was really passionate about, what was the domain I was super passionate about. And when I created Titan out of my apartment, I never expected it to be something big and incredible. It was just something I was passionate about, and it was a hobby to me. And I went out to raise capital. It was super difficult, not having the background, the pedigree, the education. I mean, the every possible signal not to back and not to support this thing was there. But through passion, just kept moving forward and added, first one person on and then the next, and really just kept going forward. But yeah, that's my general background. Dropout, serial entrepreneur, love building things. Excited about that.
All right. Well, we're going to jump right into some questions. So really starting kind of with the basics. You guys both have the perspective of serial entrepreneur and investor. What does an exit strategy mean to an investor, and what does it mean to an entrepreneur, and sort of how does it differ? So Maximus is kind of interesting because you said you went and, were seeking investment. And we'll kind of get to this question later. Did they ask you about your exit strategy up front as you were starting your company? But so I'll kind of start with you. What does the exit strategy mean to you, and what did it mean in some of your conversations with investors?
Sure. So I think early on I did the typical thing of put together a business plan and really went for a format of something that was very comprehensive and included information about an exit strategy and all of that. And I really didn't have the mentors in place. I hadn't had any exposure to investors, to Silicon Valley. My parents had generally told me to sort of stay away from investors, and so I really had no idea what I was doing going into that. Since then, I've done a number of other successful startups, and one of the things that's really stood out to me that I've learned around exit strategy is that the best businesses are built to last. And thinking about exit strategy is almost a weird thing, because you're essentially you're signaling to an investor that, I just want to get in and out of this business. And as opposed to the entrepreneur that is saying, I want to build this thing for the rest of my life. I want to turn this into something truly massive and focus on building the company. If you do that, if you execute that well, an exit is essentially going to happen. And so I think there's far fewer scenarios generally where it makes sense to even think about or address an exit strategy. Of course, the other side of that too is as we go out and build companies, to be able to see what the world's going to look like in 5 years or 10 or whatever that investment horizon is, it's just super difficult to forecast, and so much changes. So going into a startup, the most important thing from my perspective and the feedback that I've now gotten from many investors, especially the more sophisticated ones, is that go build a great business, and don't get focused on what that exit strategy is going to look like. Build it to be a good, solid business, and the universe will fall into place.
Thanks. So Tracy, you've been on both sides. You wear both hats. What does this sort of mean for you as an exit strategy, or what are you focused on, either when you're talking to a startup or when you're wearing your sort of investor hat and you're looking at investment opportunities in a startup?
Sure. Yeah. To me, let me put my investor hat on, and I'll say that hat is a hat that usually invests in sort of angel seed investments and some venture, a little bit of private equity. So exit strategy is crucial to a person like me. There are some larger, more sophisticated funds and other investors that take a longer term view, of course, and I think that's awesome if you can do it. But for me, I need to know how I make my return. And so in a lot of ways, the only way to do that is to have an exit. Now, what that looks like and we'll talk about this a little bit later, can be a lot different depending on what the business is. But exit for me means getting paid back plus a return. So it's the whole reason I do this. You got to get a return. You've got to either liquidate your position or an asset in the business so that you can get your capital return plus some upside. For me, the biggest fear is getting into what would otherwise be an awesome business. It's growing and maybe throwing off a few dollars here and there, and things look great, but you're just trapped. So you just never have a great idea of when your money's going to come back to you or how you could potentially monetize that. That's a fear for the smaller to mid-sized investor. And even the private equity guys will tell you, they've got a horizon under which they have to operate to get their capital back to their investors. So there has to be somewhat of a logical fit with your business. Now, I would agree with what Maximus said 100%, which is there is this tension between building something to last versus building something that's going to be, stomped out in 3 years. I mean, those are competing ideologies, and there's definitely a tension there. I typically look for what I would think is otherwise going to be a great business built to last, but then ask the question, okay, how do I get paid? And there needs to be an answer to that, even if it's a longer term view answer or it's an answer that has several twists and turns. The founder or the management team has to at least be thinking about that, at the very least. We can work together on what that looks like and the forms it takes, but I think it has to be there.
So you both make good points. So Maximus and Tracy, you kind of repeated this, as an entrepreneur, you're thinking, I want to have this company be as successful for as long as possible. And then also as an investor, whether angel investor versus, sort of a venture investor, your timeline is much different. What is that, just, very generally, what does that timeline look like if you're doing an angel investment or if you're doing a venture investment? I mean, is that a 1 year window, a 5 year, or does it just differ?
Yeah, well, there's not hard and fast rules, but typically people that do kind of what I do, they're looking for sort of a 3 to 5 year type window. But again, and we'll get into this later, there's some ways to, if you're a participant in a great growing business that has great long-term potential, maybe you don't want to leave, but you want to have the ability to take a few chips off the table and deploy them elsewhere. There's some other things that can happen, but, generally, if I can get my money back plus a great return in 3 to 5 years, I'm happy. But I just don't like to make hard and fast rules because every situation is different, and you'd be leaving a lot of money on the table if you did have a great, outstanding long-term business that it pays to be in for a long time. If you can manage that in your portfolio, you'd want to do that. So again, no hard and fast rules from where I sit.
So Maximus, so we're going to get a little bit into what are the different types of exit strategies. Mm-hmm. I mean, for you, did you always envision that you were going to sell the company? Was this sort of the timeline that you had imagined, or did this opportunity came up and it made sense at the time? I mean, were you even looking at this, or was this just kind of dropped in your lap?
No, it was very much dropped in my lap. And I think going back also to a little bit of what Tracy said, and my first comments is, an exit is if you build a great business and you focus on building a great, super, super valuable business, an exit is just going to happen. And the forms that can happen are anything from, you could IPO, you could go do a liquidity event with a private equity firm that creates liquidity, buys out a significant tranche of the company, creates liquidity for the early investors and the founders and early team. You can do an exit to a strategic, you can do an exit to private equity, you can decide to sell some of your stock on a less liquid, but sort of secondary market. And so the exit will happen, but to fixate and for the organization to fixate on achieving that exit instead of fixate on just go build a hyper valuable business, I think can create some cultural issues. And in our case, we were super excited about what we were building. And we initially reached out. I had picked up the phone and through a couple of folks and sort of a long shot ended up getting in touch with Mark Zuckerberg. And that was, it wasn't to go, hey, I want to sell this. This was, I read about this really cool thing that you're doing. It's similar to what we also want to do. Maybe we can work together and be part of the platform for it. And it was never even thinking about an exit. It was, how do I go build a better business, a bigger business? How do I partner with the right strategics that are doing similar things so that we can all go faster and execute this better? And out of that came, oh wow, this is really cool. Why don't we just buy you guys? And then Google stepped in, and it all sort of happened very, very quickly. So again, it was just going out, seeking those strategics and those partnerships, not with any intent to sell, but that is what happened because we had focused on building something that was really meaningful.
Great. So Tracy, what are some of the typical exit strategies that you are familiar with, and what are some that aren't, that you've come across? I know you mentioned IPO, that sort of is the more common knowledge or what we hear a lot about. How do they kind of differ, and what have been some of your experiences?
Yeah, so most of my experiences, I think Maximus laid out a few of these and pretty much covered most of them. But so you got the sale to a larger company, you got a sale to private equity, and that could be private equity that's backing a completely new with a new team that's been put together, or it could be a company that they've backed several times and has an existing ongoing business. There could be a merger. There could be what I call a recap, which is essentially usually private equity or a venture fund or something like that, buying not all of the business, but a substantial portion, leaving the existing team in place because they like them, and they continue to monetize, maybe put more wind in their sails in terms of capital to achieve a faster growth rate. We see that a lot in businesses around here. You could sell to another investor. That happens all the time. One of the better deals that I've gotten into in the last few years, there was an investor in a bank deal that was it's like a doctor's or dentist's 401k plan or something, and so they're cruising along, and their CPAs tell them, hey, this is not a qualified investment for you. You have to get out, and you have to get out in like a week or something like that. So that created a great opportunity for me to pop in and get a good piece of this bank at a discounted rate. And so you see things like that happening from time to time where it's just one investor to another. Management buyouts are another thing that we see happening. So a team has maybe some early investors, or they're bootstrapped or whatever, and they'll take an investor out and bring another investor in. We hate to think about the bad side of exits, but exits also mean, an investor can just decide, I don't want to do this anymore, or a founder could decide, I just don't want to do this anymore, I want to wrap this up. So you could be looking at a liquidation. You could be looking at just, hey, look, I'm just going to wrap it up and go home. I see people pass businesses on to family members, usually it's not all at one time. It's a planned sequence of events over a course of years to take advantage of tax situations. So there's all kinds of different exit types, and we probably haven't even seen them all. And when I have my lawyer hat on, every client that comes in here is different and demands a different type of transaction. So they can morph and change. I think the main thing to understand about these exit types is don't feel like you have to put yourself into a particular box. I mean, when I say investors want to hear about an exit, they want to know that you're thinking about it. They don't necessarily mean for you to plan an IPO or to plan a merger or to plan a recap up front. So these are things that, as Maximus said, usually just tend to happen over time in a good business. You'll have investors that want to push things a certain way. There may be some outside interested parties like investment bankers and others that offer up other ways. Just don't put yourself in a box early, because I think you have to be open to all of these kinds of things.
Great. So after an exit, generally, how long does an owner stay involved with the company? So once you go through whatever exit, you've kind of settled on, whether it's been a long journey or a shorter journey, how long does the owner typically stay involved? Like Maximus, for example, how long did, you kind of stay involved with Titan, or are you still involved with Titan after the purchase from Google?
Sure. No, I was in a very lucky position where when I came in and joined Google, and we had a lot of inertia that had developed with Titan at that point, but I was given the option to stay with Titan, continue to focus on that, go start building the next thing, or join some other project. And so I kind of got to come into this Disneyland of really cool projects and touch a lot of really different, exciting things at Google. I think in terms of how often does an owner or a founder stay involved post exit? I think more traditionally what happens well before that is actually many times founders will be pushed out of the organization before an exit happens, and it's simply the founders are usually the ones that are taking something from the zero out of an apartment, zero people on the team, and building it up. And that's what they're really good at. That's what those entrepreneurs are really good at. And as the company evolves into a later stage, there inevitably becomes a shift where outside management that has the experience to go run those 2, 3, 4, 5,000 person companies needs to be brought in. And really, when that happens, the founders are faced, and the early team is sort of faced with two things. They can fight that process, which some do, or they can embrace that process and help find help find those next folks and transitions. And we see this across the board, whether it's even a company as large as Uber or any of those. But if there is an exit that happens before that type of natural event occurs, then I think that most of the companies that I've seen, the founders and early team are usually involved for another couple of years. They might have some earnout milestones that they need to hit, so they're still incentivized to push the company forward and hit those milestones. But it certainly varies across the board, and I think at the end of the day, it comes down to how well those interests ultimately are aligned.
Great, thank you. Tracy, what's been your experience? You've worked with a lot of entrepreneurs. Have they stayed involved after exits, or have you experienced the same thing?
Yeah, I've experienced the same thing. And, what Maximus said is really true across the board. It all depends too on, what type of business it is. If you have a business of manufacturing widgets and, a particular owner really isn't necessary to the process of manufacturing widgets, then it's probably going to be a shorter term. At the same time, if that owner has all the relationships and is an outstanding team builder and, all the other things that you would expect them to be, there are good reasons to keep them around to help transition, if nothing else. So, I'm working on 2 different divestitures right now where the owners are sticking around for at least a year under a consulting agreement. It's, pretty healthy type salary arrangement. And in both of those cases, it makes perfect sense because the owner is the leader, so that they have direct input on how well this team is going to come together and how well this asset's going to be absorbed by the folks that are buying it. And they also have, a lifetime of relationships in this particular industry. So I think it depends on the business. But long story short, I think it's always healthy for transition to keep that owner or significant team member around for some period of time.
So in terms of timing, I mean, you both have given, I think, a lot of good guidance here on, it's hard to plan for an exit strategy early on. It seems to be better if it happens organically. And then I guess when an opportunity comes up where it looks like there's a potential exit, what kind of considerations did you have to go through to decide if it was the right deal, if the timing was right? I mean, was it Maximus, in your case, was it a really hard decision, or did you have to go through a lot of steps to get to the point where you thought this is a good exit strategy for you?
It definitely was a tough decision. And in our case, we had two great options. So it was a wonderful place to be, but it was a tough decision because on the one hand, you have the investors who are largely thinking about it from, what is that IRR that they're going to achieve with this deal? Which is going to be the best return? What do the liquidity events look like? How does the liquidity of that deal transpire? Is it a stock deal? Is it partially cash? So when you're comparing one acquired to the other, one might be all cash, one might be a combination of cash and equity, and then you're looking at what that future value of that stock's going to be like, because you've got lockout periods on there. So on the one hand, you have those things that the investors are all considering, and you're generally sitting on the board in that case. You've certainly got a fiduciary obligation to those folks. And then at the same time, you're also thinking about your team, and you're thinking about what is going to be the best thing for the team, for the folks that were there from the beginning, that helped build this, that helped create this and develop this value, and what do they want? And I think acquisitions are tough, and they're tough because you've got, out of the gate, you've got a dichotomy. You have an us versus them, and you have to have your culture now rolling into the acquirer's culture. And for that to be successful, it means that the team has got to go into it very positively. The team has got to bond with that acquirer to an extent before that deal is even done. And when you're faced with a couple of acquirers, that's yet another part of it is what does the team want? And I think involving them, in our case, we involved everyone in that decision, and everyone at the end of the day really felt like they were a part of that decision, and helped us really sort of select the acquirer that we wanted, and work to align all of the interests. But that ended up making it a successful acquisition, and the team integrated very well and very quickly, and was very excited about it.
Great. So Tracy, kind of as an investor, does the number of investment rounds, complicate an exit?
It can, depending on who the people are coming into the cap table. It's always, all of this always comes down to the people. Honestly, you can have the best business in the world, you can have complicated structures, you can have, a lot of money thrown around, all of these things, but it seems to all come back to the people and personalities. So you can work through, and I can work through a complicated cap table, or, maybe you've got some convertible debt in there and some other things to take advantage of. I think all those things can be worked through if you can manage the people. And a lot of this, it goes back to the very first instance of, just kind of knowing who your investors are, knowing who your audience of investors are, and being able to manage expectations, and being able to thoughtfully push your own agenda and the agenda of your team. And I like the comment by Maximus, which is, you need to try to involve everybody in these processes, because even if they don't love it, at the end of the day, at least they had a voice, and at least they got to be part of something. And I've seen this happen over and over and over again. Even the folks that didn't like the deal still adds to their resume. It adds to their track record. It always adds to their balance sheet for the most part. And it's generally positive. And that's the other thing I'd throw out there too is, you may not want to exit very early, or you may not want to exit at the multiple that's being offered, and maybe investors are pushing you and some other things, but at the end of the day, don't discount that track record, because especially if you're a young person kind of getting these things going, to have been able to build a business and successfully exit, even though it wasn't the perfect multiple for you, or you didn't like your investors, and at the end of the day you just didn't like what was going on, at least you've built that track record, and that's going to help you get the next group of investors in, and the next group and the next group. So my view of the world on those is it's always good to get a deal done. It may not be the perfect deal, and you seldom see the perfect deal. But again, I like the sentiment that Maximus threw out, which is involving everybody at least gets everybody sort of a seat at the table and a chance to participate in what's going on, because it is happening to them.
Thank you. So Maximus, so as we've talked a little bit about, when to start thinking about an exit strategy, and Tracy, maybe you've experienced this as well. Are you generally taking note of the landscape? Were you keeping tabs on Google and Facebook and saw that they were competing in high altitude aircraft and technology development? Was this something that was on your radar? or they just really came to knocking on your door?
No, we had reached out to we had reached out to Facebook because of an article that I'd read, and it looked like they had a desire to get internet out to the other 3 billion that didn't have it, and they weren't thinking about this as a platform. In fact, they really weren't thinking too deeply about what that tech was. It was almost more of a social project, and so I reached out saying, hey, we have the solution to that as a potential partnership, and then that evolved into an acquisition. So, and again, it goes back to my earlier comment: is go build a hyper valuable business, a great business. There's always going to be someone that will want a piece of that. If you or your investor or anyone else wants to lock in their gains and lock that deal in, there's always an exit option for a great business. For a business that's not so great, there aren't so many options. There aren't very many, if any, exit strategies. And as Tracy pointed out, the actual most common exit is one where the business doesn't work out, and it's a liquidation and a wind down, and that's very tough and sad to go through. So focusing on building out the best possible business that is very valuable means that there will just be a plethora of exit options. I think the one caveat I would say to that, this is probably a little later stage, but the one time to, I think, actually proactively think about an investment is when you're looking at the competitive landscape and you maybe see some things coming around the corner that are a little scary, that might you really see as threatening your business, and in your position, you really need a much bigger organization behind you, or to be part of a much bigger organization to weather, whatever that competitive event that's coming. And I think at that point, that's where it absolutely can make sense to proactively think about and go execute on an exit, so that you can kind of weather that storm or get in front of that event.
And Maximus, was this one of your first exits from a startup? Had you done this before? And now going through this experience, has it influenced, how you would feel if you had another startup and going through this process again?
Absolutely. I had some minor successes early on, but I'd also had some very painful failures early on. And this was really the one first major success that I had. And it absolutely 100% transformed the way that I think about building businesses and the way that I think prior to this, I always thought about a business of building something out that's just a nice, almost lifestyle business with strong cash flows, and you take those cash flows and reinvest and keep building a better business. But post that, it really transformed my thinking into how do you build terminal value? How do you build, and again, it's not thinking about what that specific exit is going to be, but how do you build a business that inherently is very valuable, massively valuable, and it's super exciting to go out and build those. And the hyper growth periods I went through, built a couple of businesses after that, and getting into the hyper growth phases of those businesses is just so fun and so exciting. There's so much energy, and it's really addictive to go build those types of businesses. So certainly influenced, pulled me out of the thought process of just go build a long, decades long, 20-year type term lifestyle cash flow business. Let's go build something that actually can disrupt an industry, something that's going to go affect and impact millions or billions of lives, and be something that is going to have an impact at a species level. That's what really excites me now.
So Tracy, I was wondering too if you could tell us a little bit of like some of your best case scenarios, worst case scenarios, kind of the similar question. What have you learned as going through this process, taking companies through multiple exits? What's some of your best case scenarios, and what's sort of like the worst things you've seen happen as you've gone through this process?
Yeah, I think you just heard from Maximus on the best case scenario. So the types of the building of businesses that he's talking about are what everybody's looking for. Those are awesome. It's the spotted unicorn. It's disruptive. Everybody loves it. It's a great team. those are few and far between, just to be practical. Most of the things that we look for or look at as angel and venture investors are a little more grounded in terms of potential impact. And, we're looking at a decent return, whether it's a 20, 30% IRR or, 3 to 4X on your money, is a home run. It's great. Anytime you can do that. So, but we're all looking for what Maximus described, and I haven't done a deal with Google. I still hold out hope, of course. But those are awesome, and that's what everybody's looking for. I think, realistically, most of your businesses are going to be, you're doing really good if you can hit some singles and doubles, and as Maximus said, a lot of businesses fail. I've been in a couple that failed, and they hurt. That it's no fun, and it's no fun to watch something you built go away. You learn a lot from it, and hopefully you learn it fast, and you keep going, and you correct your mistakes the next time. But I've seen things around here that I think are great if you can get a 2X to 3X type return. And in this part of the world, that's usually in the energy business. I've done a lot of oil and gas investing, and I had an oil and gas operating company that we had several asset exits that were in the 4 to 10 times returns on capital. And, those were home runs, and everybody loved those. And we sold those, and investors would say, hey, surely you can go build that again in the next 6 months. And it's just not that easy. So, we, at the stage of investing that I'm involved with, and most of my clients are involved with around here, which are the smaller and medium-sized companies, that's typically the way things look. And every now and then you see something that has just real potential, and then you're just clamoring to get into it. You don't even care if there's an exit strategy because it's so cool, right? And that's kind of what Maximus described, and that's what everybody would like to do, but they're few and far between.
Do you think there's any differences in the unmanned aerial systems industry? I mean, it's still, I guess, considered somewhat of a newer industry, and we've had conversations in previous webinars with some of our partners about valuation and issues like that. I mean, in your experience, do you see UAS being any different or having a different set of problems perhaps than other industries, or is it pretty much the same across the board?
I think the issue in unmanned aerial systems is, it's relatively new. So as you look out there in the universe of transactions that have been done or valuations that you can pin something to, or if you're doing modeling and you're trying to, look, any model you run, if it's a discounted cash flow model, it's gotta have a terminal value in there somewhere. So, do you just make that up, or can you look out to the market for transactions that are comparable? That's the hard part, I think, in this business is, this is one of those that is potentially disruptive along several lines. And so how do you even start to think about what the upside is? It's tough.
Yeah. Did you encounter any of that, Maximus? I mean, kind of in this UAS space, did that make a difference, or is it?
Yeah, no, absolutely. But, stepping back to kind of look at the UAS businesses as a whole, I think there's some really exciting applications and some exciting businesses that can be built here. And, one of the ones that I've been super excited about recently was Zipline, where they were solving a fundamental issue of getting blood to getting plasma to folks in Africa that otherwise would not have had access to that. And that was a fundamental business model that just happened to leverage UAS. And I thought that was just a super creative model. They were able to raise millions in capital and are scaling out, exactly one of those unicorn style businesses. So I think that we're going to see a lot of those style businesses that are solving a very real world problem that exists today, and they're leveraging UAS to do that.
So, you both have mentioned it, and I kind of like this idea. I'm always a big fan of you don't know what you don't know. And you talked a lot about sort of failures. What were some lessons you've learned from failures? Had you tried to exit a company before, or just in general, going through this experience? what were sort of lessons learned?
Tracy, you want to go for that? I've got lots of lessons that I've learned, painfully.
Yeah. I mean, Tracy, what have you seen that just was an epic failure, but you learned a lot from?
Anybody that's in this game or says they're in this game, has quite a few failures in some way, shape, or form, and you learn from all of them. I mean, probably the biggest one that happened to me was an operating company that I had that, we did a big acquisition. For us it was big. It was $500 million, and it was this is an oil and gas company. Oil prices were $100, and I had hedges out for 18 months at $95 a barrel, and the price of oil dropped from $100 to $25 almost overnight and stayed there for 3 years. Well, when those hedges rolled off, the math just didn't work, and we were done. And that happens in the commodity markets, and that happens in lots of different markets. Sometimes you can forecast and plan a little better for those things, and sometimes you can't. In that one, I should have put the longest hedges I possibly could put on. But we just weren't seeing that at the time. So fundamentally, we were wrong. And I think when you have situations like that, the problem that can happen in some of these businesses is, you've got a great team of people, but maybe you all think too much alike, So in our particular circumstance, we had, 4 or 5 of us that were sort of in control of the hedging decisions, and even one of our board members that were, and we all viewed the markets very similar, and we all made the same mistake, So I in my view, recognizing a healthy diversity of opinion on things like markets or forecasting is really what you need to do if you're in that type of business, and diversity in general, because some of the biggest failures I've seen and some of the biggest giant hedge funds that are run by the brightest people in the world is they were all too similar, right? So they all saw the world the same way, and something came at them and ran them over like a Mack truck because of it. So you've got to have some healthy disagreement inside your company, and you've got to push each other to understand the kinds of things that can happen, how you can plan better for them. That was the biggest lesson I learned, which is we all had a common thought process on a key issue that probably deserved more fleshing out.
That all makes a ton of sense, and I think the one takeaway that I can add to that is that we're all going to fail. Whether it's a company failing or whether or not it is some initiative within the company that failed and didn't work. And I've gone through. I've had life throw some incredible curveballs that may gone through some tremendous failures. And I think for me the biggest takeaway has been to not let those failures get to me, but to continue moving forward. And getting really good at that was one of the best things that I could have done, so that no matter what happened, I would just keep moving forward. And then that even for me evolved to a point where I almost started to appreciate or even love some of those failures, because it just meant that I'd found one other way that something wouldn't work. And I was one step closer to finding the way that it would work. So, but absolutely not getting down on yourself about that failure, but just getting right back on that horse and continuing to move forward was absolutely critical for me to develop.
So where do you start? I mean, so let's just say an exit strategy is seeming like the right option. Maybe somebody's approached you, maybe not. Tracy, it sounds like you guide people through this process. I mean, what kind of resources do you need? For a bio from Google, did you have an army of attorneys? I mean, was it just the most complicated process you've ever gone through? Or, I mean, is that something that you could really do yourself as a startup?
It was the most expensive legal bill I'd ever seen. So yes, certainly when something like that happens, especially if a Google type company is picking your startup up, absolutely. In that case, you very much want to be represented by the best attorneys you can get. But that's a great place to be in, certainly. In terms of starting from an exit perspective, I absolutely would not recommend that anyone go through that process without great representation, and there's a lot of great firms out there certainly to do it. It's sort of the opposite of what I tell people when folks approach me and say, hey, how do I start a business? And I say, start anywhere, just start going, and don't worry too much about the details. Just get going. Even on the legal side, you can go hit Cooley Go and do all the legal docs yourself. But when you're getting to an exit and you've got a term sheet on the table, absolutely having very strong legal counsel that doesn't just understand the legal aspects of that incredibly complex deal, but understands and appreciates all of the sort of business ramifications and what's happening with the team and all of those other soft points. Having someone having legal counsel who's a great communicator is also absolutely critical.
That's great.
I think on these deals that I've been involved with, and I got 2 on my desk this week, where they're divestitures, and as a lawyer working on those things, you're one part legal technician, one part business advisor, and hopefully your lawyer's got some business background and has actually risked capital in the past or knows what it's like to fire an employee. And I'll tell you, there's not that many out there that have done that. But I think it's good to have. You're also sort of a counselor. You're also a person that helps marshal or shepherd lots of different resources. And you could have real estate lawyers, tax lawyers, IP lawyers, and you've got to have a good quarterback to pull that off. The other key piece to larger type divestiture or exit, I think, are good CFO. If you don't have a great CFO, there are tons of good ones that you can outsource, and or other firms, whether it be the larger accounting and consulting firms, or even a great group of investment bankers to help model scenarios that come up in the negotiation and be able to determine the impacts, because there's just way too much to it to do as a founder yourself. No matter how smart you think you are, there's a lot of moving pieces, and there's a lot of things you have to recognize you haven't been through before, you may not understand. And there are subject matter experts out there that have seen it 100 times, and they're more than happy to guide you through it. And you're not paying so much for an outcome. You're paying for advice, and that advice comes with the fact that they've been through it before, so it can take a lot of the stress out of it too, to be honest with you, to have a good quarterback to take you through that.
Well, I'd imagine too, you really want to have an advocate. I mean, obviously everybody's trying to get the best deal on both sides. And so having someone to advocate for you and make sure that you're getting out of it what you want.
Even our tax code is incredibly complicated. So when you sell a business, you don't want to leave money on the table, obviously. So you need those folks as well to guide you through that process. And if you're lucky enough to end up with a big check, you're going to want some folks to advise you on how to reinvest that to defer taxes and other things. So I think if you're fortunate enough to have that problem, then certainly you can afford to get advisors on your side to help you through the process. And it's not cousin Larry or Aunt Sally who has a relative who's a lawyer down the street. You need very good, capable folks, especially for the type of business that you're in, to help shepherd you through that process.
Yeah, I would imagine. I mean, Maximus, in your case, being approached by Google, that could be very intimidating. Their legal teams. We got a question here from one of our participants. On the day, as you were getting involved in this process in the day-to-day, was it just lawyers around a table trying to figure it out, or how involved were other people from Google, or does this just really come down to an attorney's effort?
So one of the very intelligent things that my very first investor wrote or told us through this process is he, and this is right when he funded this seed round of Titan, is he brought on Perkins Coie at that point. There was a particular partner at Perkins who had been working with him and was really just an incredible communicator, had the wisdom of decades of experience. And in that case, we actually ended up bringing him onto the board. We ended up keeping him in the loop with the company. He put a little bit of money in. So in our case, we actually had our legal counsel that had an interest in the company as well. And so interests were even more aligned from that perspective. And so he had a background over the 2-3 years of our growth before Google happened. So when that happened, we were in a great position, and he had done other deals with other acquisition deals with Google. So we were just benefiting from the wisdom of his experience throughout the entire process. And that completely changed how it was handled and how we felt and how smooth and comfortable. And, the other side of it too is, as an acquirer, Google is just awesome. And I'm sure that that's not, how most acquirers are, but they literally came in and got the deal done in 10 days from start to finish. They were super generous. They were super generous with the team, and they were just really attentive to the details and the cultural details, and signaling that made us feel like we were actually part of their family. So, I don't think that's how most acquisitions typically go, but Tracy certainly alluded to the human element is really one of the most important in these, to help those go smoothly.
Well, I'm going to wrap up. Before I do, I want to make sure I give you each an opportunity to, if there's any parting advice, anything we didn't ask that you think is just incredibly relevant to sort of exiting strategies, and anything that we didn't, sort of touch on. So Tracy, anything, parting words of wisdom that you can offer?
Yeah, I guess the advice is to get advice. Whether it's somebody who's been through it on the business side or the invention side, like Maximus, or someone that's been through it on the legal side or the accounting side or whatever. Just get that advice. I think the other thing I'd throw out there is regardless of what the business is or what you think it's going to look like or what your long-term view is, at least be thoughtful for what concerns your investors are going to have. And that usually means you got to at least think about an exit strategy from the standpoint of, and not so much nailing it down or nailing down the timing or anything like that, but just be thoughtful about it and the fact that your investors do want to make a return, and what they do expect you to know, and this is from the very first pitch meeting, is look, what are businesses like this selling for? What does this market look like in a handful of years? How's it going to grow? How's your business going to grow in comparison to a typical business in this market? And then how do you model for what a potential exit could look like? And investors are going to do that modeling work themselves, but, they expect you to know what that market looks like. So at least know that going in and be able to be very thoughtful about it.
Yeah, I absolutely agree with what Tracy said there, especially on the go get the right advice from the right folks that have gone through that process before. I think the one other thing that's super important to focus on, and hopefully your mentors would tell you this, but you've worked super hard to build that business from nothing to the incredibly valuable entity that it is today. And what you don't want to do is go get undervalued. And it's just like everything, it's a supply-demand question. So developing a second acquirer and having a second option in the wings it's really the only way to ensure that you're going to get the best possible value for your business, and creating some of that basic competition at exit. That's certainly something that at any point where I would be thinking about an exit strategy as I'm getting close to that, or that's being dropped into my lap, going out and very quickly developing that second option is something that really is going to help you get the value, you and your investors and your team really get the right value after all this work that's been invested over the years to build it up.
Excellent. Well, I want to thank you both so much for your advice, sharing your experiences and your knowledge with our audience. All of our webinars are available on our website and also on YouTube. So I encourage this information that you've given all of us today, I think will help many. So we really appreciate it. obviously this is something that can be very complicated to navigate. And I think you give us some really good advice. Key points being to get help, get advice, get help, and sort of be open. And hopefully, Maximus, maybe you'll go through this experience many, many times going forward. So really, really exciting to hear about your experience, and congratulations on your, your big success with Google. And Tracy, thank you so much for bringing in your years and years of expertise and, all the different sides of the table that you've sat on as you've gone through this process.
Oh, thanks for having me.
Great. Thank you.
Thank you, everyone.